baby, let's talk stocks. As my six-figure brokerage account just hit all-time high, sitting at $273,000, pooping out those juicy dividends and that passive income that I live for to fast-track my financial independence to perhaps one day retire early. So hit that like button, folks, and let's get right into this because we're going to go over the entire spreadsheet overview, talk about my stock watch list and where my attention is moving toward in this secular shift from speculation and growth into valuation plays, something Warren Buffett would be more interested in, but not at the all-time highs a lot of these value stocks trade at. But however, I have just been stacking a debt of cash, and I've been trying to come up with somewhat of a cash strategy because there's just no fun looking at an account that has $14,585 in it, and I have no idea exactly what I'm doing with it just yet, but that's why you're going to consider subscribing for those future updates, folks. However, I have finished calculating my entire dividends going into the month of May. I'm still waiting for May to finish up just so I can calculate. However, though, taking a look for the entirety of the year so far, sitting at $2,570 in dividends after taxes. By the way, I do all the calculations going into this spreadsheet. Other than that, there hasn't been any crazy shifts since I kind of, moved all my accounts over into the corporate account and then got my dividend stocks into my regular brokerage accounts, which we'll see when we kind of slide on over into the individual brokerage accounts. However, taking a look at the individual position weighting, just so you guys can get an immediate overview of what's going on here, I've currently got about, like I said, $14,585 in cash. I kind of switched the way I looked at my growth pie here because I've got $65,895 in growth. I kind of allotted Bitcoin in there as well, but that would make up my Apple, Microsoft, Facebook, and Tesla and Bitcoin position. And other than that, I'm almost about to cross $200,000 in pure dividend stocks, about $7,000 away, and that is where a lot of my attention will be with a few stocks that I'm going to bring up toward the end of this video. The newest added position, as many of you might be aware, was Hydro One. I continue to add to my consumer, not my consumer discretion or anything like that, sorry, my utility sector of the market, which if we just scroll up here, guys, we can see that my utilities only make up about 12% of the entire portfolio. I feel like I'm comfortable continuing to add to that weighting, so Hydro One did make the list. I only just started a position with my last dividends that I received, so currently, if I can find it on my little list watch here, where are we looking at? $1,200 is the current starting position of my Hydro One stock. So that's the only recent added position here, folks. So let's kind of just bleed over into some of the accounts here. But first, if you guys enjoy the way my overview looks, consider supporting the channel. We actually sell these spreadsheets at thechartmaster.com. Use coupon code Passive Income Investor. You're going to get 15% off. And if you're more into crypto, we do sell a crypto spreadsheet that automates your portfolio and your crypto accounts all together in one. Sold separately, however, for $20. But nonetheless, folks, let's talk about these brokerage accounts real quick, and then I'm going to talk about the broader view of the market, just so you guys can see that I am a no BSer. These are my real brokerage accounts. This TFSA, every single stock that I bought and so far has been in the green, except for RioCan, which has been recovering nicely, even though Canada is still technically on a lockdown until about June 7th. And on the US side of this account, just as beautiful. BTI was in the green, but now it's pulling back. I've noticed that my MO, my SIN stocks, they've just been generally flatlining, which I'm perfectly okay with because both of these are like paying out an 8% yield. So you're basically getting your full market return just from the yield. It's like holding an 8% bond almost. I love my SIN stocks. Let's talk about my other account real quick. This is the account where I shifted all of my stocks out of my RBC account that eventually turned into my corporate account, which we'll see in a sec. But still, taking a look in here, guys, everything again in the green, and it would be a lot more green. I don't know why the Bank of Nova Scotia did not update my actual buy prices, because when I shift from one brokerage account to another, I thought it would save my buy prices, but turns out not the case. However, I am up a lot, like 30% on BNS and over 30% on this TD position because I bought them at the bottom of the crash. So I'm not sure why. I almost want to call the bank and be like, why can't you keep my initial buy prices? They make me feel good when I log in and I see where I bought them at. But either way, not complaining. Literally every single stock in these accounts are green except for British American Tobacco and my initial RioCan position. But again, if you take a look at how much I'm down on those guys, it's so nominal. Like, I mean, just take a look. RioCan down $500 and then $33 on BTI. So literally green, green, green. This is what happens when you don't focus on super high yields and super spec plays. You can get a nice balanced portfolio that just does amazingly, folks. And just taking a look at my RRSP. Oh, I lied. Kimberly Clark is in the red in this account for me. So, okay, I have a few red positions. We're going to see one more actually, but But for those accounts that poop out my dividends, you know, not a lot of red going on there, at least where it matters the most. But still, this is an RSP where I can't really touch this money until I reach retirement age. So this is where I keep my consumer discretion, these companies that pay much lower yields, because I want the yield compound effect, you know, the way these companies increase their dividends, to kind of add up over time. However, folks, let's talk about my corporate account, my final account. Yeah, this is the last account where I'm seeing some red because I did reposition a bit into Tesla, of course. I'm down now only $947 on my Tesla position in the corporation account. And what I'm thinking about doing is starting a whole new spin-off channel dedicated to this corporate account and starting from zero, because the way I'm operating this account is going to be drastically different than the rest of my accounts, because this is going to be the dream team. This is going to be what's going to fast track me to retirement, because I found out that being a small business that makes less than $500,000 a year, I will only be paying 3% in tax on all of the income that goes through this account and this brokerage account, which is just staggering to me. So I might make a whole spin-off channel where I make a video once every other week dedicated just to this account and what I'm doing within it, because from here on in, this is where all my money's going for the time being, folks. But we'll come back to that a bit later on. Talking about wealth, simple here with my crypto account, down 35%. This is where things go from beautifully green to beautifully red. And that's just the one crypto account, because I do have my main crypto account that is linked to my Trezor wallet, which I really love, because this is my backup and my protected wallet. I love this for emergency funds. I always feel like if I get stuck in a foreign country or something like that, that at the whim of insanity, unlike using gold, let's say, which I still have a lot of my gold cool coins sitting around here. You guys like those little gold coins or silver coins? I love precious metals. I don't talk about these as much, but I do keep them all as part of an emergency fund that keeps basically you outside of the markets and into a different asset class. So I literally just use my Bitcoin, and as much as people might be for or against it, as a pure emergency fund of something that has actual value, that's easy, it's very liquid to any currency, and depending on wherever I'm at, I feel like people would really have no problem accepting Bitcoin, which we're going to find out, because we're going to be doing a meetup in Vegas where I'm going to try and use that Bitcoin to potentially see if we can get somebody to let me gamble with it. Not a lot, but it'd be cool if somebody would let you do that. But putting all of that aside, folks, let's talk about the entire markets and how I feel and where my attention is moving forward, because right now the Canadian dollar just basically hit a 5-year high, which means if you are living in Canada, it is a phenomenal time to shift Canadian currency to US currency. And just taking a look at the US dollar, guys, it has hit obviously a 5-year low, and the chart is reloading here. So let me zoom out to the 5-year so that we can see this is what's driving up most other currencies' value right now, is the Fed continues to print those dollars, obviously devaluing everything next to it, right? Fortunately, thanks to the Biden administration increasing the capital gains rate, which I know it's not for anyone making more than $400,000 or $500,000, but what you have to understand is there's a lot of big business out there, a lot of big mutual fund managers, hedge fund managers that are trading in and out of spec plays. So what you guys have to be aware of is these big fund managers, in these moments where they can't do short-term options plays or basically trade in and out of these SPACs or anything that is very volatile because of the capital gains rate, because if you're managing $1 billion and you're trading that, making, you know, hundreds of millions or even just tens of millions, you're going to be paying a lot more tax than you used to be. So this is causing a cyclical shift from basically speculation and growth into value plays, precious metal market, anywhere people can park their cash for the entire Biden administration to avoid selling anything for a capital gain. So this is what I think is going on more intently behind the scenes, which is why we're seeing bank stocks and a lot of these boring companies that were hitting bottoms in March of 2020 going into 2021 hitting all-time highs they haven't seen in the entire history of the companies, is just due to this cyclical shift. However, this is a time where, unfortunately, most of you might have already been leveraged in growth and you might not feel comfortable dabbling back down into it, but this is your time, in my opinion, to be accumulating assets like Bitcoin, accumulating maybe some of those SPACs or growth plays that you wanted to get into that maybe you didn't. However, that's not where most of my attention is going, because right now I'm looking for the longevity of my portfolio and I'm looking for really solid growth plays that I can see pan out for the next 5 to 10 years, and where my best deals are, because I already own the companies I like Facebook and Tesla, I'm trying to diversify into these other assets, though might not run up as something fast as a small cap SPAC play. I still think have a lot of growth poised against them that people aren't paying enough attention to. And that's obviously with these companies like Google. Now, Google, I do not compare to Facebook. I think Facebook will see more growth in the near term because of its market cap being like almost, a third of the size. I mean, what is Facebook's at just under $1 trillion right now. We got Google at 1.59 trillion with a little bit of higher PE going on. But with the growth rate these companies are experiencing, I really want to add them to this trifecta. Not the trifecta because that's three. I'm looking for the word octaecta or the sixth, whatever the sixth one is, because we got Apple, Microsoft, Facebook, Google, Amazon, and Tesla being these six majors I want individually owned in my portfolios, because then I feel like I've directly replicated the S&P 500 index top 10 holdings. And same with the QQQ ETF, which represents the NASDAQ 100. Those top 10 holdings that make up 50% of that index are literally the stocks that I just mentioned. I know these are boring at this point, but these are the path of least resistance to pretty much guaranteed wealth. And we know with Amazon continuing to disrupt the shipping industry, even in Canada here, disrupting government regulated postal services. I mean, Amazon is by no means slowing down. These are the companies, there's literally like 8 companies that deal with AI, and they're pretty much all the companies that I just mentioned. I mean, these are the companies that are proving to shift into the future. These are the companies that are banking over $100 billion a year in net income, or soon to be, which is just absolutely absurd. And yet you're paying a premium for it. But guys, if you're just patient for the next 3 to 5 years, this is your path of least resistance to wealth. Now, many of us are stuck between a rock and a hard place with cash, because I don't want to just be throwing money into Google and Amazon all the time, considering they're constantly trading at all-time highs, and we're kind of waiting for another cyclical pullback in the markets, which I think will be coming in soon time, considering interest rates are at bottom basement barrel prices, and at some point in the coming years, those interest rates are going to start going up. And when they do, you usually see a pullback in the markets, including the real estate market. But in the short term, near term, you want to be finding a place that's going to keep cash flowing and being stable for you. And I know a lot of investors have been looking at like covered call ETFs, because I think the Global X NASDAQ QYLD that represents the NASDAQ 100, and it's a covered call ETF, is paying out about a 9% yield. And cyclically for the last several years, it's done a really good job at sustaining the value of the stock price while paying out such a high yield, because we can see the stock price hasn't really done anything. But if you're getting that 9% yield in the short term and you don't plan on holding this for too long, it's a good short-term Parker place for cash. However, I'm more of a real estate man myself, because I live in Canada. I will get extra taxes. These funds come with different tax implications. So I would, however, be more interested in the Canadian real estate market. I've been looking through a wide variety of REITs, because in Canada, you get benefits for owning pure Canadian REITs. So you get these tax benefits. You get the fact that these REITs have already built out cash flow. They've already kind of implemented their plans in the past. So they're taking advantage of this explosive real estate market and not running into issues like a lot of the developers are right now. And I'm not looking at development real estate. I want real estate that already exists, cash flow somewhere between a 5 to 10% yield, where I can park it with stability, at least for the near term, in case we see a real cyclical pullback in some of these more valued play stocks. And then I can maybe shift some out of the REITs and into some of those other plays. But I've mentioned these in the past. I've talked about Northview Canadian High Yield Residential Fund. This fund right now pays about an 8 or 9%. It has just been relatively doing great for the last several months since the IPO, and I might park some cash in there. We have another small cap REIT that I've looked at called True North Commercial REIT. This one just crushed it. For primarily an office REIT, it did really well through the pandemic and is now pushing back toward its all-time highs thanks to its explosive revenue growth through the pandemic somehow. And then I've also looked at some other really well-diversified large cap REITs. This is a $4 billion one that pays a starting yield of 6.3% called Smart Centers. Now, I don't want to load up too much more on REITs, just because based on my current diversification set, right now, what does the real estate market make up for this portfolio? It makes up about 16%, which is fairly substantial against some of the other weightings. That's why I've been trying to add things like Hydro One to continue building up my utility sector. And I could look more into consumer discretion, consumer staples, because they're fairly small weighted. But in the meantime, REITs seem to be one of my favorite places to focus, and I'm going to start divvying cash up probably between these 3 different funds. I'm going to do Google and Amazon. I'm going to take a percentage of my capital for high yielding short-term cash flow, and then I'm going to keep shifting my dividends from my TFSA into Hydro One, so that way I'm constantly diversifying between all these sectors that will hopefully yield the best, most sustainable results over the mid to long term. But at this point, folks, I pass the question off to you. How are your accounts holding up? What do you think in that comment section below? I would love to hear about it. And in light of all this, stay cool, stay awesome, and I'll look forward to catching you tomorrow.